Okay, perfect. All right.
All right. So welcome, everyone. Welcome to Tax Law number 3. This is credits and deductions. I hope everyone enjoyed the nice, cool, crisp weather we had out there today. I'd like to thank everyone who completed their survey and sent it back. It will help us to plan what we're going to be able to do this year. So if you haven't completed it, please do send it out. I apologize for last week for the audio issues on my end. This virtual process has certainly given me a new appreciation for teachers and what they do every day. Jared, I really appreciate the challenges you might be dealing with. Just as an update, we have not received the 4012s and test books yet. We will advise you as soon as we receive them. I know that some of you have already started and completed your certification test. The practice lab is available, so congratulations to everyone who's completed it. I will now be taking my test over Thanksgiving. The pressure's on. So thank you for that. Continue to put your questions in the chat. We will take a break. When we come back from the break, we will answer the questions that are there, and then we'll answer questions again at the end of the session. Next slide. So we wanted to do a quick follow-up on some questions we had last week from self-employment. So I'm going to ask Jared to follow up on that, and then he'll move into our credit and deductions. Thank you, everyone. Have a great evening.
All right, welcome everyone. Hopefully audio quality is coming through all right here. We are going to have a good amount of information to get through here this evening. We're going to be talking a bit more about credits and deductions, also talking about a couple new things that are occurring with the 2020 returns, but also wanted to follow up on a couple questions we had from last week, and that's include some questions about the self-employment and how that works from a VITA perspective. One of the questions that we had received was concerning the position on whether we can prepare a return that shows a loss on a Schedule C. And that's actually a requirement from the IRS. So this is actually guidance from the Internal Revenue Service that the VITA program cannot prepare returns that show a loss on a Schedule C. A couple reasons for that. One is we have a specific set of rules out that are called hobby loss rules, where the taxpayer has to prove that they were intending to make money in their business. They had a business plan, and the loss rules are a lot more complex than what the IRS would prefer us to look at. The IRS also believes that people having taxes prepared for free are going to be on a more casual basis for self-employment, and therefore should not have losses. So if we do run into a situation with a loss, unfortunately, what we'll have to do is contact the client and let them know that the return cannot be prepared in VITA. One of the other areas would be to double check that we have all the income and expenses recorded appropriately. But if they are showing a loss for the year, we cannot prepare that return under IRS guidance. A couple other questions that had arisen were involving the mileage calculations. So I just want to remind you a little bit about the rules for drivers. Typically, what's going to happen, the apps themselves will have some limitations in how they're going to calculate some mileage information. Lyft is a little bit better than Uber. Uber is only going to track mileage while you are having a paying passenger in your vehicle. Lyft will actually track mileage for the driver whenever they're considered on the clock, whenever they have their app on and available for service. However, there may be some mileage areas that would not be tracked by either one of these apps. That can be things like if a driver is moving between locations looking for a pickup, that is considered a business deduction. What's not considered business deduction is any type of personal activity. So driving to the mall because you want to do some shopping, and then while you're at the mall, you decide to turn on your Uber app. That's fine. Once you pick up a passenger, you're more than welcome to deduct that mileage, but the mileage to the mall from your house is considered a personal expense. Same thing about going to pick up food for yourself or things like that. Those are personal miles. The other caution that we have is that these mileage logs have to be contemporaneous for IRS purposes. What that means is that you have to track the miles as you're driving. The IRS does not want you to come up with mileage after the fact. So hopefully that the taxpayer is using some sort of system that they will be able to track their mileage effectively. Again, as we mentioned, there are some limitations to the apps themselves between Uber and Lyft as to whether or not they record all mileage. But there are other apps out there or a driver log that we can rely on information. And just another follow-up to questions about deductibility. One thing we always have to watch is that we are using the available resources we have to help make our decisions on deductibility. One of the clear things that we have with our ethics and our guidance is that we have to use the information provided by the Internal Revenue Service, or what we call primary authority. So these would be rules coming from the IRS themselves. So certainly use your information similar to your Pub 4012, your Pub 17, any information coming from the IRS itself, anything including tax code itself, if you would enjoy reading that. Not the best of reading, but if you want to take a look at that, you certainly may. One thing we do want to caution about is when people do a Google search or they look for websites, there's a lot of information on the internet. As you can probably tell, not all of it is accurate or reliable. So we just want to throw a caution out there for those pieces of information. So just be sure that we're using the tools and resources provided through the VITA program, and you should be in pretty good shape. If you have any questions with the returns, by all means, feel free to go ahead and contact your site coordinator and make sure that we are doing the best job we can. What we're looking to do is to prepare returns accurately and within scope for our VITA program. So that's what our certification levels will allow us to do, and also provide the most amount of benefit to our Lancaster County community. All right, so heading into our topics for today, we're going to be talking a lot more about how do we start looking at deductions. How do we take a look at areas that we might be able to reduce either taxable income or reduce the tax itself? So a couple of things we want to take a look at here are our first area are going to be our adjustments to income. Now, fortunately, these are actually going to be very similar to last year, or in prior years, I should say. These are going to be all reported on the Schedule 1 of the Form 1040. A couple things that we do have within scope, things like an educator expense, and I'll get into that in a little bit more information. The penalty on early withdrawal of savings or CD accounts. The nice part about this deduction is it automatically populates from the Form 1099 INT. So if you enter the Form 1099 INT and you see that there's a penalty on early withdrawal of savings or CD, that information will automatically flow to the Schedule 1 of the Form 1040. We'll also talk a little bit more about the rules for alimony, the IRA deduction, and the student loan interest deduction. One of the deductions that has come back this year is the tuition and fee deductions that had been on the extender list for last year and also this year. Fortunately, a little bit earlier in the year, those items were extended. So they're technically available for the 2019 and the 2020 returns. This would be a deduction up to $4,000 of qualifying tuition and fees. So fortunately, the IRS is giving us a pretty nice description of exactly what our deduction would be. It's limited to only tuition and fees. So it's only going to be those two items. So none of the other expenses that we'll talk about for qualified education would count. It is only the qualified tuition and fees. It's based on the first $4,000. The one caution we have with this deduction is you do want to double check to see if that education credit might have a greater impact to the client. Fortunately, when you enter the information into TaxSlayer, all three are going to be in the same entry area. We're going to be talking about that tuition fee deduction now, but we'll also review the American Opportunity Credit and the Lifetime Learning Credit. Tuition and fee deduction, because it hasn't been around for a little while, will automatically populate on the Form 8917. Getting into a little bit more detail on the educator expenses. Again, if you have questions with these, your reference in the upper corner is going to show you what we're looking at here. It's going to be the E4 of your 4012. What we're going to be doing in this case is we are allowing eligible educators to deduct up to $250 of qualified expenses paid during the tax year. Now, this $250 level is per taxpayer. So if you have a married filing jointly return and both individuals are eligible educators, they can deduct each up to $250. And when we talk about eligible educator, what we're talking about is a teacher, an instructor, a counselor, a principal, or even an aide in a school. Now, homeschooling does not count. It actually has to be either a private or public school and has to be teaching in grades K through 12, so kindergarten through 12th grade, and they have to be employed for at least 900 hours during the tax year. So if they're employed during the year, they are eligible for the educator definition. So the next question is, what kind of things are actually going to be qualifying expenses? Well, these are going to be our general classroom supplies. These can be things like books, other equipment. That includes computer equipment, software, services, items that they may need for bulletin boards. What we're looking at, particularly with online education, maybe some things that we were looking at here in terms of maybe some apps that they're getting, maybe some access to websites can all be considered activities that will be deductible expenses. If they're taking professional development activities, so if they're taking some additional coursework, again, particularly with the transition to online education, if they're taking a course on how to better teach over a remote session, that would be includable as well. The one caveat we have is that they cannot be eligible for reimbursement for these expenses. So if the school offers a reimbursement and the teacher declines, then the deductions are not eligible for a qualifying expense, particularly in that professional development area. Also, another interesting thing are for anyone in the health or physical education areas, we cannot include expenses for non-athletic supplies. So if you're a health teacher or a gym teacher and you're buying non-athletic supplies, those are not deductible. I'm still trying to figure out how in the world someone had been that traumatized by their health and physical education teacher in school that they are not allowed to take those deductions like other educators are. So I've yet to figure out why that occurs, but unfortunately for our health and educator in physical education, we're not allowed to take those deductions at this point in time. Likewise, like I mentioned, if they have any school reimbursements, that's going to reduce the amount that's eligible. And for the professional development activities, if they're eligible for reimbursement and they choose not to take the reimbursement, we cannot include those. Typically, most times, if you have a qualified educator, they will provide the list of information that they've purchased throughout the year, much like any other expenses. We're going to take the educator on their word, and they will have the ability to provide documentation to the IRS if it ever comes up to that area. All right. So what we're going to do is move on to alimony. And alimony is an area that's still around. You may have heard a couple areas that people may be confused about the change in alimony rules because at the end of 2018, we had a bit of a change. So any divorces that were actually executed after 1984 and before 2019, the rules are still the same. We still have an alimony deduction by the payor, and alimony received is still going to be income by the recipient. If they had gotten divorced in 2019 or later, then the alimony is not income to the recipient and is not a deduction for the individual paying the alimony. One of the areas that you'll notice when you go ahead and you enter information, TaxSlayer will be asking for the date of the divorce. So that's one thing that we're going to have to double check. I believe that was also on the returns last year, but just something you want to double check with your clients as we go through the process. There is no paperwork generally provided. This is not like a W-2 or a 1099 where we can get the information. It's typically going to be provided by the client as to how much they've either paid or received. And what we'll take a look at is making sure that that gets matched up appropriately. So if you do have a conversation with the client, just be sure to let them know that whatever is deducted on one return, the IRS is going to try and match that to the recipient return as income. So what does qualify as alimony? Well, payments are going to be treated as alimony if all the following requirements are met. So we have a fairly broad bullet point list here. So the payments have to be required. So they have to be a required payment by a divorce or separation agreement. The payer and recipient spouse do not file a married filing jointly return, which should not be a problem because they're actually divorced. The payment has to be made in cash or cash equivalent. So it has to be either paid in cash or perhaps a bill or an invoice was paid by the former spouse. This is always a fun one. The fourth one down is actually a double negative. So the issue we have here is a payment is not designated as not alimony. So what we're looking at is basically that the divorce decree does not call these payments not alimony. If it specifically says in the agreement that these are not alimony payments, then the IRS is going to follow that, and they're going to treat these as not alimony payments. A couple other things that we have to take a look at is that the spouses are legally separated. They have to be under a divorce decree or separate maintenance agreement. Here in Pennsylvania, we have the divorce decree rule. So if they're legally divorced, then alimony would be applicable. They can also not be in the same household. A couple other issues we have with alimony payments is that they have to stop at the death of the recipient spouse, so they cannot continue past the recipient's lifetime. And they also are not going to be child support. So as long as they're not child support payments, they can be considered alimony. And again, for most people, if they've been divorced before 2019, they should be pretty much aware of the rules and should provide the information we need for both the alimony deduction and also the alimony recipient record that as income. Another area that we have here is the IRA deduction. One new change that we have here is that the age 70.5 limitation for making contributions is eliminated. So in the past, if you had reached age 70.5, that was a required minimum distribution age. You no longer have to worry about the inability to contribute to an IRA. You can still do that at any age now at this point in time, as long as you have that. As long as you have the ability to contribute. Basically, you need earned income in order to make a deductible contribution. The nice part about the IRA deduction is this is actually what we consider a post-tax year planning opportunity. So you can make an IRA contribution all the way through April 15th of the year you're filing the return. So if you file a 2020 return, you have until April 15th of 2021 to make your IRA contribution. And we'll talk about a strategy in a little bit here, a little later on this evening, about how to potentially mitigate some issues with the Affordable Care Act and some areas where we may run into some repayment issues. Now, the deductible contribution limits haven't really changed. They're $6,000 per individual for 2020. If you're age 50 or older, you get another $1,000, so it's up to $7,000 if age 50 or older. Now, if the individual or spouse was actually covered by a retirement plan, there may be some limitations. So when you take a look at entering the W-2, be sure you take a look at the check boxes. There is box 13 on the W-2. Usually the middle box there will say participant in a retirement plan. So that will automatically allow the calculations to go through properly. We just have to make sure that those are checked in accordance with the preparation of the W-2. So these are relatively automatic. Now, the problem is we may have to go ahead and double check with the taxpayer if they made an IRA contribution or if they're planning to make an IRA contribution. Again, we don't really get much information during the return preparation itself, so it may be an area of clarification. One other area that we take a look at for deductibility is student loan interest deduction. So this is on E11 of your 4012. We get a good amount of questions here about the student loan interest deduction. There are some AGI limitation rules. These will not apply to VITA clients. If they're in the VITA program, they are automatically underneath the AGI limitations. Now, what we're looking at here is that the qualified loan is going to be a loan either for the taxpayer, the spouse, or a person who was a dependent of the taxpayer at the time the loan was taken out. So this could be a parent who had taken out a loan for a child while they were in school. If the child has since graduated, they're filing their own return. The parent is still eligible to take that interest deduction as long as they are legally obligated. They're legally liable to pay that debt. The loan has to be paid within a reasonable amount of time after receiving the loan. Generally not a problem. Student loan will want repayment almost immediately. So we usually do not have any issues with that reasonable amount of time after receiving the loan. Has to be taken out for an eligible student, meaning that they are at least half-time at an accredited institution. And one of the things that we take a look at is usually to be eligible for the aid, the student has to be enrolled at least half-time at a school. Now, what are the deduction limits? Well, it's going to be the lower amount of either the interest paid during the year or $2,500. So whichever amount is lower. So whenever you put the information in, fortunately on Tax Slayer, it's fairly easy just to drop in the amount of student loan interest paid, and it will automatically take the lower of either the amount that you entered or $2,500, whichever is lower. Couple reminder rules that you cannot file married filing separately and take the student loan interest deduction. You may not be claimed as a dependent on someone else's return. So if a student is repaying their student loan debt and they are still claimed as a dependent on someone's return, they are not eligible to take the student loan interest deduction. The individual must be legally obligated to pay the loan. So a question that may come up is if a grandparent decides they want to help out their grandchild and pay the student loan for them, can they take the interest deduction? They may not unless they are legally liable to pay the loan. What would happen is that information then would be treated as a gift, again, non-taxable to the student, and the student can then take the student loan interest deduction. Loan proceeds have to be used to pay for qualified tuition and other higher education costs. Now, what's interesting about the student loan interest deduction that we'll see different from a few other education benefits, this includes your books. This also includes room and board, so you can actually use these as well. One other area I just want to mention, a change in the Secure Act, this was in 2019, that you are now eligible to take out $10,000 from a Section 529 plan to be applied toward principal or interest for a student loan. So that's $10,000 total. That's a lifetime amount that you can take out of a 529 plan, but it does provide another opportunity that is allowing that to come out tax-free to pay down $10,000 worth of student loan interest or student loan principal. Another area that we're seeing that's going to be a change here for 2020, this is a brand new deduction, the charitable deduction. This is for 2020 only so far. We'll see if it gets extended at all, but right now it's only on the books for 2020. This is a $300 charitable contribution, which is deductible, what we call above the line. So this is actually a deduction for AGI. This is going to be one of those other adjustments. It applies only to taxpayers who do not itemize. So if you itemize deductions, you are not eligible for the $300 contribution deduction. In that case, you would have to itemize your deductions. This is only applicable for taxpayers who do not itemize. The contributions have to be in cash to a qualified charitable organization. So the key that we want to focus in on there is a cash contribution. We cannot do the non-cash property donation. So dropping off clothing or furniture to Goodwill or some other type of organization will not be eligible. It's cash only. The substantiation rules would still apply for the taxpayer. So if the government requires substantiation, it'll be up to the taxpayer to prove that they made those donations. That can either be in the form of a contemporaneous receipt from the charity, or if it's under $250, you really do not need substantiation, but you do want to go ahead and indicate those charities with probably a listing of who you had paid and when those payments were made. All right, so in addition to those, a couple changes here for 2020. So this gets an opportunity for me to update our slide set here and talk about some new interesting things. We're going to be talking about some of our common non-refundable credits. Interesting part here, we really don't have any changes from the prior year. So these are all going to be continuing over and pretty much in the same amounts as what we've seen before. These are going to be showing up on the Form 1040 Schedule 3. I know a question that we had last time was concerning the foreign tax credit. Typically, we will not be seeing the Form 1116. For VITA purposes, we will generally take the automatic foreign tax credit. As long as it's $300 or less, or if you're married filing jointly, it could be $600. And the investment sources and taxes are reported on a Form 1099 INT, a Form 1099 DIV, or Schedule K1. Then we're going to go ahead and report those directly on the Schedule 3 Line 1 for a foreign tax credit. No Form 1116 is required. In fact, if we have to file a Form 1116, that will put us out of scope. So what we're looking at here for VITA is that we would typically see tax withheld on a foreign stock, a foreign account, some sort of foreign municipal or mutual fund. Those would all be reported on our brokerage statement or 1099 DIV or INT. Those will automatically come over as long as they are less than $300 or $600 if you're married filing jointly. A couple other ones we're going to be talking about are the Child and Dependent Care Credit. That's the Form 2441. We're going to spend a lot more time talking about education credits and also talking about the Retirement Savers Contribution Credit. Okay, the first one we want to address is a credit for child and dependent care. Again, a little bit more information on the G10. This one's actually a very unique credit. What we're looking at here is that you are eligible to take a credit based on qualifying expenses as long as you have one child, or $6,000 if you have more than one. So in this case, it's only going to basically count for the first two children, $3,000 for the first, $6,000 if you have more than one. One of the other unique aspects about this credit for child and dependent care is the credit is applicable for everyone. So the credit's going to range from a 35% of your qualifying expenses down to 20%, all depending on AGI. Good news is you do not have to memorize this. You do not have to do any manual calculations. This is all going to be done within TaxSlayer itself. So it doesn't matter if you have $10,000 of AGI or $10 billion if you happen to be a Jeff Bezos. You can still take a 20% child and dependent care credit. One thing you do want to take a look at when you enter the W-2, if an individual had applied for pre-tax benefit of child or dependent care credit, those amounts will be shown in box 10 of the form W-2. As long as you're entering the W-2 with all the information, it will automatically populate to the correct form. In fact, you'll typically get a warning diagnostic if you do not report credit for child and dependent care. So you just want to watch those and maybe have some questions for the individual in case you do not see any information for child and dependent care. So what are the rules for these? Well, we're looking at care for one of the following types of qualified individuals. So it's going to be for a qualifying child under the age of 13. So what we're looking at is 12 or younger. As long as those expenses are incurred before the child turns 13, that's fine. So if the child turns 13 on November 1st of 2020, you can take all the expenses for that child from January 1st through October 31st, as long as they were still 12. So you need to claim the child as a dependent. If for some reason, like we talked about in the first session, that you have a non-custodial parent taking the child as a dependent, they do not get the child and dependent care credit. Only the custodial parent, where the child lived for more than half the year, is eligible for the child and dependent care rules. In addition to a child, you can also take a dependent of the taxpayer that's either physically or mentally incapable of caring for themselves, and they also live in the same house of the taxpayer for at least half the year. Or the taxpayer's spouse who is physically or mentally incapable of caring for himself or herself and live with the taxpayer for at least half the year. And what do we mean by that physically or mentally incapable? Well, these are, by IRS definitions, people who have issues about dressing, cleaning, or feeding themselves. Or also people that may have constant attention to prevent them from injuring themselves or others. That would be eligible as a child and dependent care expense. If you're filing jointly, both spouses have to have earned income in order for this to qualify. So unless the spouse is actually the one who needs care, generally we're going to see that both spouses have to have earned income. Now, a couple things that we just want to point out about the child and dependent care credit. We need to have an EIN or social security number from the provider in order for us to deduct this or to qualify for the credit. Oftentimes, you may talk to a taxpayer and they say that they have after school care and they have a neighbor down the street that provides the care and they pay a total of $2,500. Well, if we do not have the social security number for that individual, we cannot take the child and dependent care credit. We need that social security number. At times, some of the individuals may be reluctant to provide their information because they may not be reporting that as income. So we run into a bit of an issue there that if we do not have the taxpayer identification number, we cannot take the credit on the return. Now, a couple other things that can come into play. A lot more people may be eligible for the credit and dependent care credit than what they think. If you have expenses for before or after school care, if you have expenses for day camps, so sending your kid to the summer away to a soccer camp or Lego camp or science camp, they all count as child and dependent care costs, as long as that child's under the age of 13. The one wrinkle we have is that camp cannot be an overnight camp. So as long as it's a day camp, those costs will qualify. So we may have a lot more people who are eligible. I've run into the situation before where you end up finding that you actually have a lot more Individuals who are eligible for this credit, again, there's no AGI phase out. You get the credit up to 20%, no matter how high your AGI is. And as long as they meet the other rules, it's eligible. One little trick for entering this information within the VITA system: once you're in the form 2441, you have to actually enter the expenses twice. One for the provider, and then in the second step, you're going to have to go ahead and enter the expenses per qualifying child. So first time you do it, it may take you just a little bit longer because there's a diagnostic that shows up saying you haven't completed all the steps. But that's effectively what we want to take a look at to make sure that we have the provider information and it applies to the correct dependent on your return. One of the other things we want to take a look at are going to be our education credits. As I mentioned, the tuition and fee deduction is available again this year, but oftentimes the education credit is going to be a much more powerful opportunity. The reason why is a deduction, the tuition and fee deduction, reduces your taxable income. So that's going to reduce taxable income dollar for dollar. An education credit, on the other hand, is going to reduce your tax liability dollar for dollar. So if we have a choice, usually the education credit is going to be a much more powerful opportunity than would a deduction. Fortunately, within VITA, most of our taxpayers will be underneath the AGI phase-outs for our 2 credits available. One other benefit we have is the American Opportunity Credit is partly refundable. So that's actually a very nice benefit for taxpayers. So we're going to be talking about the 2 different types of credits available. It's American Opportunity and Lifetime Learning. General rules for both these credits is for eligibility. It has to be either the taxpayer, the spouse, and or a dependent who's claimed on the return who attended an eligible post-secondary educational institution. A couple other things that probably don't sound out of the ordinary here: you cannot file return as married filing separately, and the individual cannot be claimed as a dependent on another return. So what we're looking at here is if you have a individual who's at college and their parents are still claiming them as a dependent, the student cannot take the education credit. It would only be the parents who would be eligible to take the education credit. What are we looking at here for expenses? Well, these are going to be tuition. So whatever the tuition cost is and certain related expenses required for enrollment. So these would be things like educational fees, charges that are instituted for the school, for things like technology or certain fees that are related to schoolwork itself. What doesn't qualify are going to be our room and board, kind of our personal living expenses. So if you pay for food, clothing, that type of thing, these are not deductible. They do not count as qualifying expenses for the education credits. So any of those expenses, commuting costs, are not deductible either. Now, one of the unique things that we're going to see here is that most times in order to take the education credit, you should be getting a Form 1098-T that's generally provided to the student. Oftentimes, because of the electronic distribution of these forms, they may not have one right away. So as a taxpayer, they may have to go back and request a student download a copy from their school's financial aid or the bursar's office and get you additional information. In addition, while we should probably be good, most colleges charge enough tuition that the limitations won't be a problem to reach. At times, we do need to go ahead and double check more information, including how much students had received in scholarships or other payments. So one of the things we're going to take a look at is we may need some additional information from, again, the bursar's office or the Office of Financial Aid, just to see how much the taxpayer has paid. Any costs that are paid on behalf of the student qualify. So whether that's in cash, credit card, or loan, count as education costs provided by the taxpayer. You have to reduce these expenses by any amount of non-taxable scholarships or fellowships that are received by the individual. But in most cases, we should be in pretty good shape. If you have questions with those, again, feel free to consult with your site coordinator, and we'll be happy to work through that with you. The other issue that we take a look at is that the costs are going to be for any education that is paid in 2020. So that would include any academic periods beginning in 2020 or anything that begins in the first 3 months of 2021. So particularly if you have students in college or you're aware of the process, typically schools will start sending out their tuition bills for spring 2021 semester right around this period of time. So most people have to pay these in November or December before they go back to school. So if you paid $5,000 in December for tuition that is applicable for next year, for spring 2021, you get to deduct that $5,000 or use it for education credit purposes on the 2020 return. So as long as it's for education provided in 2020 or the first 3 months of the 2021 semester, you can still use those on the 2020 education credit calculation. Couple things that we want to talk about here, just the difference again in the education credits. The American Opportunity Credit is the most powerful of all the credits. Couple reasons for that. One, you can get a $2,500 credit based on only $4,000 of tuition costs. So it's a relatively low threshold to get over. It's permitted only for the first 4 years of post-secondary education. What we're taking a look at here is going to be the tuition itself. It also counts for qualified related expenses. So that is course materials, that includes books, supplies, and any equipment. So if you need to purchase a laptop or a tablet for school, that can also qualify for the education credit areas. Up to 40% of the credit is going to be refundable. So even if you don't have a tax liability, you may get up to $1,000 federal refund, even if you don't have any federal taxes due. Couple other things we need to take a look at is you have to be enrolled in a program that leads to a degree or certification, and you have to be enrolled at least 50% of the normal full-time workload. If you get a copy of the 1098-T, there's actually a checkbox at the very bottom of that form that indicates that the student is at least half-time student status. That would allow you to go ahead and continue the process for the education credit. Another wrinkle we run into here is you may not have a felony drug conviction as of 2020. So you may have any other felony conviction under the sun, whether it's murder, whether it's grand theft auto, whatever the felony is, that's not a problem unless it's a drug conviction for distribution or possession of a narcotic. They are ineligible. Again, when we take a look at how rules are made, apparently someone, in order to get this bill passed, was adamant that they were not going to give out credits to drug convicts of a felony opportunity. It's an odd question to ask. Hopefully our clients know whether or not they've been convicted of a felony drug conviction. A couple other things I just want to mention while we're in here is that, again, the payments that are made for education costs are going to count whether they're done in cash, credit cards, or borrowed funds. If funds are paid by someone other than the student, for example, if a grandparent wants to help out and pay for college education, those funds are going to be treated as being paid by the student. If the student happens to be a dependent of his or her parents, then those funds are going to be treated as being paid by the parents. So if a grandparent wants to help out and pay some college tuition, and the child is a dependent of the parents, then the parents can use those costs for the education credit. One of the other ones that still applies is the lifetime learning credit. This one's still nice, but not quite as powerful as that American Opportunity Credit. This one's a 20% dollar for dollar on the first $10,000 of qualified tuition and other fees. So it's a $2,000 credit maximum. There is no refundable component. However, there's no limit for the number of years a credit can be claimed. So when we take a look at the American Opportunity Credit, it's for your first 4 years of post-secondary education. Now, what's unique about the education system is we typically have a student enroll for 5 calendar years. So because most schools will start their education process in August or September, and they finish in May of the subsequent year, that's actually one academic year is actually straddling 2 tax years. So if you have a student who's actually sticking around for a 5th year, or they may have taken some credits and have delayed their graduation, they'll be out of the American Opportunity Credit after the first 4 years, but they are eligible for the lifetime learning. Again, no limit for the number of years that can be claimed. What we're looking at here are going to be course-related books, supplies, and fees and equipment, as long as they are purchased from the institution itself. So for the American Opportunity Credit, we don't care where you got those. You can buy your books and materials from Amazon, again, helping out Jeff Bezos, or any other institution. For the lifetime learning, they have to be purchased through the school. They have to be bought through the school in order to qualify. However, you can still use the tuition and other expenses as well. There's no requirement for half-time enrollment, as long as this is for a program that's going to lead to increase your work or just at an eligible institution. So if you decided you wanted to go ahead and take a evening class to learn French or astronomy, you were actually eligible for a lifetime learning credit. The other way this can come into play is it doesn't matter what conviction you have. You can be convicted of anything and still get the lifetime learning credit. So if someone doesn't want to answer the question on a felony drug conviction, we can actually direct them to the lifetime learning credit and see if we can get any benefit for those. The last credit I want to talk about here for the non-refundable piece is actually the Retirement Savers Contribution Credit. Get more information on G13 of your 4012. This one typically is going to be an automatic calculation. It's going to be on the Form 8880. And if a taxpayer has made an eligible contribution to certain retirement plans, they will get a credit on contributions based on their AGI. Now, what kind of accounts will qualify? These are going to be our traditional Roth or IRA accounts. Again, the caution that we have with these is we don't always know that a taxpayer has made a contribution to a traditional or a Roth IRA. Usually some more information that we need to glean from our taxpayer. So we may have to ask them whether or not they are have made or intend to make a contribution to a traditional IRA, or if they've made one to a Roth IRA, because a Roth IRA contribution is eligible. The other elective deferrals to a 401k or 403b plan, these automatically come over from the Form W-2. So as long as we see those codes of an E or D, those are going to be our elective deferrals to a retirement plan. Same thing with a elective deferral to a government 457 or a SEP or Simple. Those should all come through as well. So typically, like I mentioned, these are going to be reported in box 12 of the Form W-2. So these are going to be our codes D, E, F, G, H, S, A, or BB. So it sounds like we're running through all the letters in the alphabet, or we're trying to solve a puzzle in Wheel of Fortune. But those are our typical codes that are going to indicate that we have a retirement plan contribution. So that includes elective deferrals to a Roth 401k, traditional 401k, our government plans, 403bs, SEPs, and Simples. Couple rules of eligibility. So the taxpayer cannot be a dependent, nor can they be a full-time student. So we just, if you take a look at the check boxes when we set up in TaxSlayer, if there is an opportunity to indicate that the taxpayer is a full-time student, that will prevent the automatic calculation of the 8880. The taxpayer has to be born before January 2nd of 2003. So what we're looking at here is, if you take a look at those, we're basically looking at people who are older than 18, but they cannot be a full-time student. So fortunately, if you're born on January 1st, you get an extra year of eligibility. I guess the downside is your parents didn't get a deduction for you because you were born one day late to be considered a dependent on their return for that year. Your birthday celebration generally consists of usually a meal of pork, sauerkraut, and mashed potatoes if you're here in central Pennsylvania. A nice part, you get fireworks the night before. But if you're born on January 1st, you do have eligibility a year ahead of all the other people born in that year. One other thing we have to take a look at is if you have taken a retirement distribution in the prior 2 taxable years or up to the extended due date of the tax return, we have to reduce that eligible contribution. So you do not get a retirement savers credit. So we may see some issues here, particularly if people have taken advantage of the COVID distribution rules. If they've taken money out of a retirement account for whatever reason, doesn't matter if they have a valid reason or not, those distributions will actually decrease the amount of the retirement savers contribution credit. Easy way to look on these is to go back and take a look at the prior year returns and see if any amount has been reported on a 1099-R, which would show up on page 1 or page 2, depending which year of the Form 1040. A couple other things that we wanted to take a look at here are some additional credits. These are actually the refundable ones. These are the ones that we see for individuals that they're going to get the most amount of opportunity coming back to them. So we're going to be talking about the child tax credit and credit for other dependents. That's going to be on the Form 1040, line 19. Also going to populate schedule, actually Form 8812. The earned income credit is going to be showing on line 27. We're also going to just mention here at this point, if you have any estimated tax payments that an individual has made, that includes a carryover from a prior year, those will be showing up on line 26 of the Form 1040. I'll just take a look at the child tax credit, again, G2 of your 4012. This has been updated much, much higher than where it had been just a couple of years ago. So we've been seeing this now for the past few years, but it's up to $2,000 per qualifying child. The partially opportunity for refund means that you can get up to $1,400 of a refundable credit. And again, that's going to automatically calculate within TaxSlayer. You do not need to do anything additional for the calculations. Couple rules on eligibility. The child has to be under the age of 17 as of the end of the tax year. The one thing that's often confusing with the Internal Revenue Code is that we keep changing the rules for child. The rule for a qualifying child for dependent is under the age of 19 or under the age of 24 and a full-time student. The definition of child for the child care credit is under the age of 13. But this is specifically for the child tax credit under the age of 17. So if the child turns 17 during the tax year, they will no longer be eligible for the $2,000 child tax credit. In fact, this may be one of the big reasons we have people's refunds change, because we're actually dropping from a $2,000 partly refundable tax credit down to a credit for other dependents, which we'll talk about in just a minute. So in order to claim the child tax credit, they have to be a U.S. citizen, a U.S. national, or a resident alien. So they have to meet these definitions, a little bit more strict than what we have under the definition of a qualifying child for dependency. So the child must be claimed as the taxpayer's dependent. The non-custodial parent is eligible to claim the child and as a dependent and take the child tax credit. Again, as we mentioned, if that Form 8332 is attached to the return, it just provides a guarantee for the non-custodial parent that the IRS will not question their deduction. Now, one of the other things we take a look at, the child must have a valid Social Security number by the due date of the return. So we talked a little bit about those other identification numbers. They need to have a valid Social Security number by the due date. That is not a question at all. They have to have a valid Social Security number in order to be eligible for the child tax credit. Now, I mentioned that there is a refundable component. That's called the additional child tax credit. This is basically in two different situations. So if you have a taxpayer that has more than $2,500 of earned income, the credit's going to be based on the lesser of 15% of their taxable earned income over $2,500, or whatever amount of the non-refundable child tax credit has not been applied before. Kind of a long way of saying the TaxSlayer software will calculate this for you. If the taxpayer does not have any taxable income, or if they have actually used part of their child tax credit to eliminate any tax, you can get an automatic additional child tax credit. This can also qualify if someone has 3 or more children. So this will also kick in if we have 3 or more dependents that meet the eligibility rules as well. So as I mentioned, one of the main areas that we may see in a decrease from a credit on a return from 2000 to something else is because the child had turned 17 during the tax year. Well, all is not lost. They're actually still eligible for the credit for other dependents. So that is a little bit more information again on the G4 of your 4012. This is a $500 credit. So these are people who do not qualify for the child tax credit. Generally, where we see these are when a child has turned 17, all the way through that they're claimed as a dependent on the return. So the eligibility rules, the dependent cannot be a qualifying child tax credit for anyone else. They are only going to be your dependent. we can take a look at those dependency test rules for the qualifying relative as well. So the primary one that we see are traditionally children living in the home or maybe away at school that still count as a dependent, but they're no longer under 17. You still get a $500 credit for that. You may also qualify for a credit if you're taking a qualifying relative. So that may include your parents or someone else or a sibling that you have on your return. You just have to take a look at the dependency test rules again that we reviewed in our first session on C4. Much like the child tax credit, they have to be a U.S. citizen, U.S. national, or resident of the U.S. Residents in Mexico and Canada do not qualify. So they have to be a valid U.S. resident, U.S. national, or resident of the U.S. So one of the other things we take a look at is the dependent must have a valid identification number. This one's not as strict. The child tax credit, we need a social security number. This one, they just have to have a valid identification number, whether a social security number, ITIN, or the adoption tax identification number, the due date of the return. Okay, one of the last credits we want to take a look at here, again, saving the best for last, and we'll probably go through the earned income credit here and then probably take a quick 5-minute break to catch up on some questions and a couple other items that are popping up in chat. But one of the main reasons that we see such large refunds on returns is the ability of the earned income credit to return funds back to taxpayers. Earned income credit is so powerful, it has its own section within the 4012. This is the I tab in the 4012. The information we show here is referenced on I2. This is designed as a refundable tax credit for workers who do not have a significantly high amount of income. What effectively that's happening is that they may end up owing no tax and also get tax money back. So they're going to get tax credit back for income that they never paid tax on. What are the qualifications? Well, they have to have earned income. The predominant one we're going to see is going to be wage income. Also counts if they have self-employed business income. On occasion, we may see a taxable long-term disability benefit if they receive prior to minimum retirement age. So what we're looking at is if someone does not have the ability to work, and we're taking a look at their receiving long-term disability benefits, those are eligible as well. A couple other rules that we have here: your investment income may not exceed $3,650. Again, for most people in VITA, not a problem. That would be traditionally what we'd be looking at are interest income, dividend income. That does include, however, capital gains, rental income, passive activities from K1s. But traditionally in VITA, we don't really see a whole lot of those. Probably no surprise, as we've been talking about ever since week one of the worst filing status you could possibly have is a married filing separately. So if the taxpayer is filing married filing separately, they are not eligible for the earned income credit. That is not going to be allowed on the return. Much like the child tax credit, everyone on the return, the taxpayer, the spouse, and qualifying child must all have social security numbers. So no ITINs, no ATINs, they all have to have social security numbers. If you have a client situation, we may hold the return until they actually have the social security number provided, but we cannot claim the credit unless we have valid social security numbers. Again, they cannot be a dependent on someone else's return. And if you have a situation where they had claimed the earned income credit, they were not eligible for the earned income credit, they may be banned for a period of years for claiming that. So we just want to be sure that we didn't run into any situations where someone had been disallowed a credit in a prior year return. Now, where this actually gets some benefit, I'll show you a chart in just a second of how this will play out. What we have to take a look at are a couple rules about who's eligible for the earned income credit. One of the things that can actually maximize your opportunity is to have a qualifying child. And the qualifying child rules, again, as I mentioned before, change depending on what section of the tax code we're looking at. So the qualifying child are similar to the dependent rules. Not exactly the same. They're going to be similar. What we're going to do is we're going to throw out that support test. So now we don't care who provided support to the child. When we took a look at the dependency rules, what we said is the child cannot provide more than half of his or her own support. Well, that doesn't matter anymore. If the child provides more than half his support, they can still be considered a dependent for earned income credit purposes, just not as a dependent for tax purposes. The residence test applies only if the child lived with the taxpayer for over half the year. So what does that mean? Well, what it means is that the individual has to be living in the home. It has to go with the custodial parent. So if you are a custodial parent and you waived your opportunity to take the child for dependency purposes and the child tax credit, they are still your opportunity for the child care credit and the earned income credit. So we have to look at the custodial parent rules. So they have to be with you here in the U.S. for at least half the year. And again, they have to be a U.S. Citizen or resident alien all year as well. So if we have some issues with people coming into the U.S., refugees, they may not qualify for the earned income credit because they have to be here all year as a U.S. citizen or resident alien. Now, why does the qualifying child become important here for the earned income credit? Well, taking a look at the table here, and just for reference purposes only, you don't need to memorize this, is taking a look at the earned income credit table for any single head of household or qualifying widow or widower status. If you do not have a qualifying child, you need to be between the ages of 25 and 65. So there are some areas here that kind of preclude you. So what they're trying to do is kick out anyone who is a student, basically, again, that earlier than 25 and older than 65. So those are going to be things like individuals who might have a part-time job. If you're over 65 and you don't have a qualifying child, you're not eligible for the earned income credit. If you're between 25 and 65, your earned income has got to be less than $15,820, a relatively low amount. And that maximum credit is only $529. Once you start getting qualifying children, this jumps up dramatically. So if you have a qualifying child, then the age restriction comes off. You could be 18 years old, filing a return on your own with a qualifying child, and your earned income now just has to be less than $41,756. And that's going to give you almost a little over a $3,500 maximum credit. Again, the credit's going to be determined on a number of factors. That's how much earned income you have, and take a look at all the other factors in place. That's actually going to be a calculation done by TaxSlayer. If you have two children, that amount goes up to $47,400, and the credit goes up to a little over $5,800. If you have three or more, I'm not quite sure we have the more in there. Three is your maximum number. You can get up to almost $51,000 of earned income and receive a maximum refundable tax credit of a little over $6,500. Now, the one thing I do want to caution about here, particularly as we're seeing the impacts of COVID, we may see a change here in terms of how much earned income credit people may be eligible for. If they have had jobs in the past, and they've had a number of part-time jobs that have provided earned income to them, and this year, because of COVID, they either are not working or taking unemployment, just bear in mind that the unemployment income does not count as earned income. So if you're collecting unemployment, that is not earned income for purposes of the earned income credit. So where we may have some problems is if someone had a part-time job and they made $20,000 a year with one qualifying child, during COVID, they were not eligible to work, or they stayed at home while their children are cyber schooling and they're collecting unemployment. They may have a dramatic decrease in their earned income, which would also dramatically change their calculation for the earned income credit itself. So I just want to put that caution out there. We may see some changes. Hopefully it won't be impacting our clients too much, but we just want to mention that as we go through. Again, the qualifying child does not need to be dependent on the return, provided the other rules are satisfied. What we're looking at there is that can apply for a custodial parent that waived their dependency exemption, or that the qualifying child for earned income credit provided more than half their own support. So they don't have to be on the front page of the return in order to be a dependent for earned income credit. Now, I also just want to show you the married filing jointly one here. You notice that there's one filing status we didn't cover. We covered three of them here: single, head of household, and qualified widower, and married filing jointly. You may be asking, what happened to the married filing separately? Well, easy enough. We don't need to worry about it. You're not eligible for their earned income credit if you're filing separately. Now, the married filing jointly, you can see that those have bumped up a little bit. The earned income level is a little bit higher than what it is for the single head of household or qualifying widower, but the maximum credit stays the same. All right, so we're approaching 6:30 here, and thought this might be a good time for us to take a 5-minute break, if that works for Michelle from your perspective.
Perfect. Thank you.
One of the nice situations we have here is because these rules are in place for divorces that were completed before December 31st, 2018. Even though we say don't typically rely on the prior year, if in prior years they have been deducting alimony and the recipient spouse has been including it as income, we continue with that same process. So we don't need to go ahead and try and determine whether or not the divorce is legal or not. We're just going to take the client word that they are divorced and follow what has been done in the prior years.
All right. Next question. Where does the charitable deduction get entered in tax layer? In itemized deductions, so this is the $300 above the line.
Right. So the $300 above the line, I believe, is going to have its own separate entry within the other adjustments. I believe that's what we're looking at in the 4012 is going to indicate that. I haven't been able to see that yet in the practice lab, but I believe that's where the $300 is going to be entered in the other adjustments column.
Okay. So for what it's worth, if I put in $300 as a cash contribution and deductions, it jumps into the above the line, but that may not be the final mechanics of how Slayer works.
Right. Yeah. And in taking a look at the 4012, it looks like it had popped up in the screen for the other adjustments. So that might at the time be going from both places over to if you enter it into the itemized deductions as if you're not quite sure whether or not they qualify, and they do not qualify for itemized deductions, it may automatically flow to the other adjustments area.
Yep. Got it. Okay. Next question. Can you give an example of when someone would use tuition and fees deductions versus lifetime learning?
Yeah, so good example between those two would be if we're trying to do certain things. And this is actually a great planning technique. Usually the American Opportunity Credit is always going to be more powerful than the tuition and fee deduction itself. However, one of the main things we're going to take a look at, particularly if we are in a situation where, particularly for the advanced premium credit for the healthcare, the marketplace healthcare, a strategy we can use to drop adjusted gross income is to actually take the tuition fees deduction. So it may be beneficial to try and decrease a taxpayer's AGI to prevent a massive repayment back for that advanced premium credit. Or because the lifetime learning credit itself is not refundable, we may be trying to do other things to drop adjusted gross income and our tax liability that we may create a refundable component of, say, the child tax credit. So one of the nice parts is when you enter the information within TaxSlayer, they're all three going to be in the same component: the lifetime learning, the American Opportunity, and the tuition fee deductions. You can actually toggle back and forth between those and take a look and see if it makes a difference, whether it's being a tuition fee deduction or a lifetime learning credit. Now, I will caution, if you enter all the information in first to lifetime learning, then you check the tuition and fee deduction, it erases all the information you put in from the 1098-T, so you have to re-enter that again if you go back to the lifetime learning. But like I said, traditionally the credits are going to be more powerful, but great question, because there are some examples where we may want to reduce AGI, either for, like I said, the shared responsibility, the advanced premium credit repayment, or to try and maximize the refundable piece of our child tax credit.
Okay, thanks for that. The next question, this relates to the education credit and the economic impact payment. If the student is employed, can they not file as a dependent, get the AOC and economic impact payment? The parent would give up the $500 dependent credit.
Yeah, so that's kind of an interesting planning opportunity there for the student to go ahead and take themselves as a dependent on their own return. So basically, the parent would not claim the child as a dependent, which would then make the student eligible for things like the American Opportunity Credit, student loan interest, and then also the recovery rebate credit, which we're actually going to be talking about on the next slide here. So as long as those criteria are met and we are comfortable taking the position that the student may take themselves as a dependent, that their parents will not take them as a dependent, then there could be a possibility that they could take the American Opportunity Credit, the economic impact payment, and also the student loan interest deduction if eligible.
All right. Last question in the chat. What is the due date for filing the 2020 return?
As of now, it's April 15th again. Probably all depends on how things move. Quite honestly, the last tax season was the first time since I've been practicing that they've moved the deadline, other than for the occasional temporary relief due to things like isolated storms or holidays. So right now, the due date is still April 15. We'll see if anything changes, but it would probably take another massive shutdown of the government and state systems to extend that further than April 15.
All right. And then, sorry, just one more dropped in.
Sure.
Could tuition be on an American Opportunity Credit while room and board goes as tuition and fees?
No, so you can only take actually one or the other for a student. So you can't actually take two for the same student in the same tax year.
Got it. Okay. And those were all the questions. Thanks.
Okay, and actually, follow up to that, Jeff, is some people ask about using 529 plans for paying for college. So like we said, anything that is non-taxable is going to reduce those qualifying costs. So scholarships can reduce it as well. 529, although the nice part about a 529 plan, those expenses can be used for room and board. So if people are using a 529 plan, you can actually apply the 529 payments to room and board and not have to reduce your opportunities for tuition and fees. Okay.
Sorry, one more.
Sure,
Ari, yeah. Alimony. Sorry, regarding alimony, are the payer, taxpayer, and recipient taxpayer of alimony required to provide the Social Security number of the divorced spouse?
Yes. So we should have those in order for the IRS to match those up. So again, because we're looking at a situation where the only things that would be taxable and deductible are for divorces before December 31st, 2018, the taxpayer and spouse should already have had that information from prior year returns. So as long as we have that information from a prior year return, we should be in pretty good shape. I know it's a difficult conversation to go ahead and pay alimony and then ask your ex-spouse what their social number is. But hopefully they already have that because they would have been required to have that for the past several years.
All right, got it. Thanks. And those are all the questions then.
Oh, perfect. Okay. All right. Well, we will take a look here at a couple different things. We're going to take a look at a new recovery rebate credit, which I'm sure is going to be interesting because we still don't have all the answers yet for this one. And then we're going to move into a couple other areas that were traditionally going to be in our advanced certification, like itemized deductions. We're going to finish off with a couple other reminders about how we handle some healthcare areas, and then also HSAs are going to be discussed this evening as well. So kind of a potpourri here as we finish off session number 3. What we're going to be talking about first is recovery rebate credit. And I know that when we had first discussed this, there were some questions about the terminology. What we had seen in the earlier part of 2020 was what we called an economic impact payment, an EIP. These were advanced payments based on a yet to be enacted recovery rebate credit. So we actually have two different terminology for the same thing. So the economic impact payment was an advanced payment for the recovery rebate credit. A little bit more information on H8. I'm anticipating that we're going to see a corrected sheet here from the 4012, which will give us some more information about what that recovery rebate and EIP will look like, where we can get some more information on that. So I'm anticipating that we're going to get some additional info from the IRS. Just as a reminder, what the recovery rebate or EIP was U.S. citizens and U.S. resident aliens were eligible to receive the EIP of $1,200. If they were married filing jointly, they could get $2,400. If they were not a dependent of another taxpayer, so kind of going back to the question we had about a student who is being claimed as a dependent, they were not eligible for the EIP. The individual has to have a work-eligible Social Security number. So the key that we have here is work-eligible Social Security number. So if they have a Social Security card that says not valid for employment purposes, they are not eligible for the EIP. They have to have had an AGI less than the threshold, and I just want to point these out. All of these are well above our threshold for VITA. So if clients are coming in for VITA, I just want to point out what these thresholds are. $150,000 for married filing jointly, $112,500 for head of household, and $75,000 for other eligible individuals. So the reason I point this out is if based on their 2018 or 2019 return, whatever the IRS had on file, they would base the EIP off that information. So if we had someone who in 18 or 19 has a significant amount of income, they've now retired or they've lost a good amount of their income and they come in now, we can prepare their return as long as they meet the criteria coming into VITA. And they would get the difference in the credit. So if they did not get the full credit or any of the credit in the summer payments here, they are eligible to take a look at the recovery rebate again. A couple things that we're going to see. This can apply for like the situation where someone was a dependent in a prior year and now they are not. So if they are not a dependent of another taxpayer for 2020, they would be eligible to get up to the $1,200 EIP. Another situation that we also have a $500 credit available for the qualifying child. Now these rules are going to be following the child tax credit eligibility. So for children under the age of 17. So if a taxpayer had a child born in 2020, they would actually get the opportunity here to take the $500 credit for the new children if they had not gotten it before. Now, one thing we probably may get from some taxpayers is when they receive the economic impact payment, they did get a form or a letter in the mail, a form 1444, which is a confirmation letter of their economic impact payment. If they have that, that is fantastic. That's going to allow us to confirm how much they actually had received. I'm anticipating at some point that the government will provide a lookup service for us, much like kind of where's my refund, that we will probably be able to use to confirm whether or not the taxpayer had received their full EIP. So just something to take a look at there. But again, I think we're going to see some more information coming about the economic impact payment and the recovery rebate credit here as we move a little bit closer to tax season itself. So again, we're looking for some additional guidance from the IRS. This was a brand new credit that Congress had put in. Basically, they had passed the law before they really had developed all the rules here. So kind of a unique feature for getting cash out to the U.S. taxpayers. What we want to take a look at next is going to be itemized deductions. So now getting back into an area here for purposes of deductibility. One of the things we don't often see is the itemized deductions. And the reason why is because the standard deduction has gone up so high. It's much, much higher than it's been in several other years. So a couple things that we take a look at here are the traditional situations we'd have for VITA deductions are going to be looking at things like medical and dental expenses. For 2020, that has been held at 7.5% of AGI. A couple of years ago, they had been looking at keeping the 7.5 only for those 65 or older. That is not a problem anymore. It's 7.5% for everybody in terms of deductibility for medical expenses. Now, we don't often see medical and dental expenses exceeding 7.5% of AGI, mainly because of the almost requirement for medical insurance now. Typical situations we may see are going to be things like retirement home costs, nursing care costs, and I'll go over a couple of medical expenses on our next slide. Other areas in which we see benefit for itemized deductions are going to be homeowners. So if someone has a home mortgage interest, it's going to be shown on a form 1098, And this is going to be for any type of interest used for a purchase, acquisition, building, or improving the home. That can actually be deductible. What changed a little bit is a rule here for home mortgage interest under a home equity loan. So before, you could actually use a home equity loan for whatever you wanted it to. As long as it was secured by the home, you could actually use that interest as a deductible element. But we don't have that anymore. That actually changed back in the 2017 tax law change. And what we're looking at here is the only home equity loans that we can use would be if the proceeds were used to either buy, build, or substantially improve the qualified residence. So if you took out a home equity loan to refinance credit card debt, or if you used a home equity loan to finance a college education plan, those are not deductible. It has to be used for buying, building, or substantially improving a qualified residence. So that's one thing we would take a look at there. Other things we take a look at, mortgage insurance premiums are now back in as a deduction. Those were actually extended. So the mortgage insurance premiums you may have seen on the Form 1098. If you enter those in the appropriate section of TaxSlayer, they are a deduction for itemized purposes. Same thing as real estate taxes. So fortunately, we have a section directly within TaxSlayer that you can enter all that information directly on the same form. A couple other things are the state and local income taxes. For the majority, those will actually flow directly from the W-2s. What may not flow in, what we're going to be taking a look at there are going through and adding in a couple of those other deductions you'll see on the W-2 itself. Things like our PA state unemployment insurance and our local services tax. Those can be added in as additional taxes paid for purposes of itemized deductions. A couple other things that we take a look at here are also areas of qualified charitable donations. So these, again, are going to be qualifying charity gifts. They have to be made directly to the charity. They can't actually go through a non-exempt entity. So if someone's saying that they're going to hold a race for charity and part of your proceeds or part of your registration fee goes to the charity, that's not a direct contribution. Same thing if you round up and you give $1 at your local pharmacy, that's not a charitable contribution either. They have to be given directly to a charity. They cannot go through a non-exempt entity to count. Again, what we want to take a look at are just reminding taxpayers of the documentation rules for purposes of charitable contributions. If it's in excess of $250, they should have contemporaneous acknowledgement from the IRS. I'm sorry, from the actual charity to provide to the IRS if requested. But hopefully we don't have too many of those issues where these are going to go under audit. Interview tips, again, those are going to be things that we see in the F3 of their 4012, just to go through if you're taking a look and seeing whether or not we have any opportunities for itemized deductions, some things that you may want to down in your notes as we go through the process. A couple other things we see, gambling losses. If you have gambling winnings, you may deduct your gambling losses to the extent that you have gambling winnings. Now, this is only if you can itemize deductions. And just as another quick pointer on the real estate and state and local taxes, we still have a $10,000 cap for those. So your combined real estate taxes, state and local income taxes are $10,000 for the Schedule A, which for married filing jointly couples, if you're taking a look at a standard deduction over $24,000 and only $10,000 is allowed to come from your real estate taxes, you're really going to have a lot of mortgage interest and charitable contributions to be looking at an itemized deduction, particularly for married individuals. One of the big areas that we see outside of the home ownership and some of the tax payments are going to be medical expenses. So a couple things we want to take a look at here for medical expenses are going to be who's eligible for medical expenses. Well, these actually apply not only to the taxpayer and the spouse, also the dependents on the return. It actually also applies to people who could have been a dependent on a return, except that they don't meet the gross income test. Their gross income is too high, so that'd be a qualifying relative. Or they filed a joint return, or they were claimed as a dependent of another. So we actually really break this out a lot more and take a look and see, well, actually, we may have more medical expenses to deduct. Again, because we have a relatively high threshold, 7.5% of AGI, we may not even see deductible medical expenses. But if we're close, we can always go ahead and check to see if they're paying medical costs for qualifying relatives. Now, what does count? What we take a look at here would be things like medical costs themselves. So your out-of-pocket medical costs, your co-pays, your doctor visits, those types of things, your dental visits, any eligible long-term care premiums, if you have prescribed medication programs. So it has to be prescribed by a qualified medical practitioner. You cannot self-medicate. It has to be a prescribed medication. Medical miles are also allowed. And if you take a look at publication 17, there's actually a table in there, 21-1, that'll provide a very robust list of qualified and non-qualified medical expenses. Same thing for our 4012. There's actually a list of medical expenses in there as well. So what we would take a look at is how that would play out. Again, taking a look at those costs. One of the big ones we typically see is if you have an individual who is in a retirement facility and they're in nursing care. Traditionally, you'll get a form from the retirement community indicating how much of their monthly care is related to medical expense, and that would be a deduction as well. So a couple other things we want to take a look at here is that's kind of our main areas we'd see for our itemized deductions: medical expense, home ownership, charitable contributions. Again, we don't really see a whole lot of itemized deductions coming through for VITA. We'll probably see a little bit more of that coming through on a single side, just because that $10,000 tax cap only allows for a couple more thousand of deductibility for either charitable contributions or mortgage interest, that type of thing. So I think we'll probably see a little bit more for singles, and we will married filing jointly couples, particularly for VITA itself. So one of the things that we take a look at are going to be looking at the Affordable Care Act. So what we're looking at here is fortunately no changes from the prior year. The Affordable Care Act piece, fortunately, if you had prepared returns last year, got a whole lot easier, because all we had to do was basically go through a check mark system and say, did you purchase healthcare through the marketplace, yes or no? If it was no, that's it. We didn't have to do anything else. This is only going to apply for taxpayers who purchased insurance through the marketplace itself. What we would take a look at here is that they should be getting a Form 1095-A. That's going to be required to complete the return. That should be received hopefully by January of 2021. Again, we no longer have a shared responsibility payment for failure to have health insurance or qualified exemption. So we don't have to go through a lot of the rules that we had looked at before. So there is no longer a requirement to have an exemption or pay that shared responsibility payment. What we do have, just as a reminder, the question is going to be, for each person on the return, did the person purchase medical insurance via healthcare.gov, aka the marketplace? If yes, then you have to complete the Form 8962, and we're going to be filling that in with information off of that Form 1095-A. So what we take a look at here is how that would come out. And again, we need that Form 1095-A in order to complete the information. Typically, the reason why we are getting the 1095-A is because of the premium tax credit. So if the individual has participated in the marketplace, and again, the only way that they can participate in the marketplace is if they cannot get insurance through any other type of program. So that they're not eligible under their employer plan, they're not eligible under Medicare or Medicaid, that they can only get insurance through the marketplace. So a couple things that we take a look at is they can get the premium tax credit if they meet a couple requirements. Again, you do not have to do the calculations on these. These will automatically be applied for you. That their income is at least 100% of the federal poverty level, but not more than 400%. And we're going to talk about that area in just a second when we talk about that advanced credit piece. If they're married, they have to file a joint return. So they cannot do head of house. You cannot do married filing separately unless you fill out a special form, the 8962, which effectively is kind of an abandoned spouse type issue. You can also file separately if you qualify for that unmarried for head of household status. Again, you cannot be claimed as a dependent by another person on the return as well. So what do we typically see? Well, because that there is a credit available for the marketplace, typically what will happen when individuals sign up for marketplace insurance, the marketplace, whether they do it on a self-certification or if they work with a operator through the 800 number, will attempt to estimate their amount of taxable income for the year in question. So what they're looking for at enrollment time is how much income do they expect to earn in 2020. The marketplace is then going to go ahead and project a premium credit that the taxpayer generally applies to reduce their monthly insurance premiums. So if the premium would normally be $800, but the taxpayer would get a $600 per month credit, they usually will elect to have that $600 credit applied against their monthly premium and only have a $200 out-of-pocket payment. The Form 1095A is going to show the amount of these advanced credit payments made during 2020. So again, one of the filing requirements we have is you must file the Form 1040 if you received an advanced premium tax credit. Again, just as a reminder, that form should be received by January 31st from the marketplace. If the taxpayer does not have it, they can log into their marketplace account or they can call the Marketplace Service Center. The information for this is found on H13 of your 4012. If there are any errors that the taxpayer notices, they should go back to the marketplace for a corrected 1095A. We are required to use the information provided on a 1095A. We cannot modify any of the entries based on the 1095A, even if they're in error. They have to have a corrected one from the federal government. A couple other things that we may run into here, that premium tax credit. TaxSlayer is going to calculate the amount of the credit based on a couple different criteria, how much income they had. Oftentimes that the amount of estimated income the taxpayer used when they enrolled may be different from what they actually have on the 2020 return. Sometimes the taxpayer is going to estimate too high and they actually are pleasantly surprised that they get an additional credit. Oftentimes, it's going to go the other way, that they actually have more income in 2020 than what they originally estimated. And again, the caution we're going to have here is because of the unemployment compensation that people are receiving with the additional $600 per week taxable amount, that their income may have changed dramatically and been higher than what they had originally estimated. So we may run into more situations where the taxpayer's income has gone above their calculated advanced premium credit. Again, TaxSlayer will calculate that for you. We don't have to do anything about it. We do want to remind taxpayers that if they do have a change from their original estimate, they should immediately update the information with the marketplace to prevent this situation from happening. The marketplace can adjust their credit on a monthly basis. The problem we run into is if the taxpayer was getting a $600 per month credit and their income went up dramatically, they now owe part of that $600 back. So if you take a look at that, and we're looking at a period of 10 months, that could be a $6,000 tax bill. And unfortunately, we have seen that in the past, particularly if their repayment is going to be if they're above 400% of the federal poverty level. Now, not to shock anyone and to say we're going to run into these all the time, there are some areas that we can run into some planning opportunities. In fact, I ran into this situation last year. One of the returns that came in at the very end and tried to get in right before the deadline, and we ran into the problem that her income was above 400% of the federal poverty level. And she was going to have a significant high five-figure, close to, just a little over five-figure tax balance due. Fortunately, we were able to take a look and see how can we get the adjusted gross income beneath that 400% level. Well, one of the things you can do is to use that IRA contribution strategy, because the taxpayer had just turned 50. They were eligible to do an additional contribution of the $7,000. So the normal $6,000 plus they had the additional $1,000 eligible for them. So by making a contribution to their IRA, they were able to bring their AGI down, and they actually ended up getting a little bit of money back from the government rather than owing several $1,000s. Now, it doesn't always work for all circumstances, but there are some strategies we can use. IRA contributions, HSA contributions, or as the question came through chat a little bit earlier, maybe taking things like a tuition and fee deduction to go ahead and reduce your adjusted gross income. So those are always some options that we have available there. Just want to point out that as long as the information is relatively straightforward, these are pretty easy to go in and get into TaxSlayer. There are some situations that are beyond scope for VITA. Those include calculations for any newly married taxpayers. So we may have a situation where we have two 1095As coming through. That's going to be out of scope for VITA. Same thing if we're doing any shared calculation payments, that's going to be out of scope as well. But hopefully we won't run into too many of those situations. I just want to provide some opportunities for running into potential problems and how we may be able to help solve those with the taxpayer. A couple other things we just want to remind you of: first-time homebuyer credit and repayment. These are going to be for homes that were bought in 2008. The repayment started in 2010 for a 15-year period, so we still have a couple years to work on these. Similar to alimony, these should have already been reported on prior year returns. If the credit, typically a $500 repayment, is made each and every year, as long as they were a client before, they should automatically have that pop into our system, and it should automatically show up as a $500 repayment back to the government. Typically what will happen is that $500 will actually just reduce their refund that they're expected to receive. If clients have any questions as to where they're at, there is actually a first-time homebuyer credit lookup tool available on the irs.gov. There may be some situations where they may no longer have that home. Maybe the taxpayer had died, maybe they sold the home, maybe they no longer use it as a personal residence. If that's the case, then we have to get into a little bit more complexity and fill out the form 5405. So just want to point that out. Again, not on the, I don't believe it's on the exam, but just want to point that out for some potential situations here for first-time homebuyer credit and repayment. Again, the typical situation will be we have a client returning and they're well aware of the fact that they have a $500 balance due. They've already been paying this essentially for 9 years, so they should be accustomed to the fact that they would have a reduced amount of refund. All right, now finishing off on a couple different notes here. I want to kind of talk a little bit about HSAs. These kind of bounce around all over the place. We used to have a separate exam just for the HSAs. These are now going to be part of our advanced certification. And just want to remind people of how these work. Always struck me as odd why these had their own separate calculations, because they're relatively straightforward in terms of how we work with the HSAs. Again, we're seeing a lot more HSA accounts coming into popularity because of the nature of healthcare today, that we have individuals that select what we call a high deductible health plan. Information on the HSAs is going to be found on E6, particularly for areas of contribution. So if a taxpayer has a high deductible health insurance plan, so what that means is effectively their premiums are lower, but they have a much higher amount out of pocket that they would need to pay before insurance kicks in. That's either self or family coverage. They can establish an HSA, or health savings account. This is going to be used to pay for those out-of-pocket medical expenses. The nice part about these is that, unlike the flex spending account, these amounts do not expire at the end of the year. You can carry these over indefinitely. So these can be used at any point in time for qualified health costs. Now, one thing we want to take a look at are identifying contributions made to the HSA. If you ask a client, I know this year is going to be a bit different because we won't have as much face-to-face conversations with the taxpayer, but they may believe that they're actually making contributions to their own HSA, but oftentimes the employer will allow them to make those contributions on a pre-tax basis. So take a look. There may be some things on the W-2 that's going to indicate that we have some HSA contributions made on behalf of the employee. So there may be something in the box 12 for employer contributions. That includes any amounts that the taxpayer made with pre-tax dollars. Those were not eligible for a deduction. Oftentimes, the taxpayer may give you a form, the 5498 SA, which is going to show how much contributions have gone into the account. Again, we just want to reconcile that a little bit with the W-2, just making sure that they were not all done on a pre-tax basis. For the most part, most individuals are doing their HSA contributions pre-tax. That doesn't mean we may not have some post-tax contributions. That can certainly happen, but usually we'll want to see that 5498 SA to verify the amount of contributions made and just reconcile that with the W-2s. We're going to have the form 8889. That's going to be showing all the contributions and then also the distributions from the HSA. So the HSA, we have some unique areas. One is the amount of money going in, and secondarily, the amount of money going out. One interesting part about the HSA is the HSA contributions are also deductible for purposes of Pennsylvania. So you can actually take a deduction for HSA contributions. Now, distributions. What we take a look at here are distributions from an HSA are also going to be reported on the 8889. What we're going to get is typically for an HSA, you're going to get two forms. One is the amount showing any contributions, the 5498, or the amount of distributions that people are taking, the 1099 SA. That's going to show any distributions from the account. Now, these distributions from the HSA are not going to be taxable if we meet the following qualifications: that we used all the distributions for qualified medical expenses during the year for a qualifying person, which means the taxpayer, the spouse, and or dependents on the return. Those are going to be the same things we looked at for Schedule A medical expenses. Things like co-pays, things like dental expenses, eyeglasses, medical supplies, as long as they qualify, are HSA deductible. Well, oftentimes what will happen here is we'll see a HSA plan provide a debit card for the provider, for the individual who owns the HSA. That debit card can only be used at certain areas. So typically it can be used for someone who has a copay or other items like that. So what we just want to do is just double check with the client to make sure that those are deductible contributions. Also, what can qualify is if you rolled over an HSA from one plan to another. Sometimes when you change employers, they may have different HSA providers, and you may just combine the accounts so that way you don't have to pay fees for low balances, everything along those lines. So if you roll over into another HSA, you're exempt from taxation. Now, part of the problem we run into, if you use a distribution for anything else, not only is that amount going to be taxable income, but it's also subject to a 20% penalty. So we thought the penalty on an early distribution from a retirement account was bad. That was only 10%. This is a 20% penalty. So if you take $1,000 out of your HSA because you wanted to buy a brand new TV for the holiday season here, your tax is going to be $1,000 taxable income from the HSA, and you automatically have a $200 penalty that's going to be added to your return. So just some things to take a look at there. If people are taking money out for non-medical purposes, the penalty can be quite substantial. Now, these would include some exemptions from the penalty would be if you're dead, if you have a disability, or if you've reached age 65, then you can actually take those out without running into the penalty position. They're still going to be taxable, but we can avoid the penalty. All right, so that's where we're basically at for our presentation piece. We have a couple opportunities for some questions coming in. And Michelle, do you want me to advance to the next slide here as well, or do you want to save that for the wrap up?
Let's save that for the wrap up if you don't mind.
Perfect, all right. We have a surprise slide coming up soon. So give everyone a chance to stay around and answer, see what the questions look like and see what we can come up with here.
Okay. First question, do you get the EIP if you are married filing separately?
Yes, so the EIC can apply in that situation as well. And we actually ran into that a little bit with situations where people may have had a spouse that did not have a valid social security number. So some changes that could have been made were to file separately to try and get the EIP, but that also causes a whole lot of other controversy. Because as we mentioned, marital filing separately is not your best status typically for tax purposes, including standard deduction, credits, that type of thing. But yet they should have been eligible for that as well.
All right. This relates to charitable contributions made through Facebook.
Yeah.
If the assumption is they would not count as a charitable contribution, does that mean Facebook would take the deduction and not recognize that revenue?
Yeah, so hopefully that we're not seeing these entities kind of double counting those. So whether you're giving through a specific charity organization, like if Facebook's trying to raise funds for something, that they should not be treating those as non-taxable income and then taking deduction themselves. Similar to if you go to the pharmacy and they ask if you'd like to give $1, or the grocery store, you want to give $1 for a specific charity. They should not be including that as revenue, and they do not get a deduction for that. So it's really, they're just collecting it for someone else. But for IRS purposes, the IRS wants those to go directly to the charity, not through a non-exempt holding company. So it cannot go through that way. Now, hopefully these are going to be relatively minor amounts. But in cases of Facebook, maybe people are doing some larger contributions. Maybe a good example, and maybe a plug here for the United Way, Michelle, is tomorrow is the Extra Give campaign, of which the United Way is a participant. That's being run through the Lancaster County Community Foundation, which in and of itself is a nonprofit entity. So making contributions through that entity to go to your designated charity would be deductible. But having them go through a non-exempt entity does not create a charitable deduction. They have to go directly to a charitable organization. Similar things we run into if you want to help the homeless and you give a homeless person money or food, that's not deductible. But if you give money to a homeless shelter or a church and they give money to that individual, that would be deductible. So it's a similar concept of how the IRS views those. They cannot track things like your grocery store or Facebook to find out what they did with those monies.
Jared, thank you for the plug about the extraordinary give. So this year, we're really excited. The United Way is designating funds, if you go in to contribute through the United Way, either to 211, which is a great part of the United Way, is very in touch with all of our clients. They set up our appointments for us, but you also could give directly to the VITA program. So if anyone's interested in doing that, please consider donating to VITA. Thank you.
All right, the next question. Where are the post-tax contributions to an HSA reported on the state form?
Well, those should be coming over, I believe, automatically if they're in the 8889. And I would have to double check that. Michelle, are you aware if there are any other adjustments that need to be made?
I am not actually. I wrote a note, Jared, that we need to do that. Why don't we come back and address that on the state section, if that's okay?
That is perfect. That'll give us some opportunity to address that a little bit later here. Yeah. So we will double check the correct reporting of that. But my most software systems I work with, it automatically calculates for Pennsylvania purposes.
Yeah, from my experience, they do. On my returns, they carry.
Yep, perfect. And we'll cover that right after Thanksgiving as well when we talk about some state and local areas. In addition to the HSA, we're also going to have a 529 deduction as well. Again, not seen all that often within VITA, but I'll point those out as well. Things that we can actually do to reduce PA state income.
Okay. An HSA follow-up. Explain HSA contributions if the person no longer has the high deductible plan. Can they still make deductible contributions?
No. So in order to make a deductible HSA contribution, you have to be enrolled in a high deductible plan at the time. So typically what will happen with the 8889, it'll actually ask you how many months were you actually enrolled in a high deductible plan. So that would theoretically, if someone had a plan adoption that wasn't necessarily at the very beginning of the year, and they may have only been in a high deductible plan for 6 out of the 12 months, that they're going to be limited on how much they can actually contribute to an HSA. Once you actually are eligible for Medicare, you are no longer eligible to contribute to an HSA. However, those funds that are already in there can still be used permanently for medical costs. So you cannot add any more money to it, but you can still use the funds in there for qualifying medical costs. We're seeing this as really an opportunity because when we take a look at those itemized deductions, Not many people get much deduction anymore for their medical costs. That includes kind of their dentist visits or eyeglasses. But if you have the opportunity to participate in a high deductible plan, contributions made to your HSA are going to be tax-free to you, and they're not taxable when you pull them out to pay for medical costs. So we're seeing a little bit more of this HSA in popularity, and I think the IRS has finally conceded and put this in as part of our advanced certification and not its own separate certification.
Got it. All right. That was all the questions in the chat.
Oh, okay.
Okay, Jared, if you'd move to the last slide.
Sure.
No problem. It doesn't matter if it's up or not. I just wanted to wish everyone a happy Thanksgiving.
Oh, I'm sorry. I will go ahead and bring that back up there. Sorry about that, Michelle. Got a little excited on my clicking here. Hopefully that's back up there again for you.
It is. Thank you. Wanted to wish everyone a happy Thanksgiving. Let you know that we will not have a tax law session next Thursday. Enjoy the time safely with your family. And we will regroup again on Thursday, December the 3rd at 5:30. Our fourth session will include state and local. So that's why we'll follow up on some of the questions we had this evening. And then we will have our break and we'll come back and do military. Military is a separate certification so that if you were not planning on certifying military, you'd be able to leave us after the question and answer. So thank you, everyone. Thank you, Jared. Have a great Thanksgiving and talk to you in 2 weeks.